Greetings, scholars. In this video, we'll talk about Chapter 23, Computing Default Adjusted Bond Returns. In the previous two chapters, we looked at managing interest rate risk in bond portfolio management, but default risk is a substantial risk associated with fixed income investing. So let's look into that. So some bond basics that we know about already. And I suppose the main point we want to make is if I go over to a bond spreadsheet that we were looking at previously, the cash flows from a bond are known with the expected cash flows are known with some certainty, right? These are contractually obligated cash flows from the issuer, and then given a discount rate, we can find the price of the bond, and if the issuer makes all these scheduled interest and principal payments, we can figure out the return that we would earn on this bond investment. And actually, if you buy the bond and hold it to maturity, and all these interest and principal payments happen, you'd earn a return equal to the yield to maturity per year. But bonds default, and so we need to account for that. And there's a couple ways to measure default risk. The market's perception of default risk can be represented through the default risk premium. Let's take a quick look at that. The spread between triple B bonds, so Moody's credit ratings, BAA corresponds to triple B. The spread between triple B bonds and treasuries gives some sense of how the market is pricing default risk. And you can see default risk is a big concern over the last month or so. So credit ratings are one measure of default risk as well. And we can see that the lower the credit rating, on average, the more likely defaults are to happen. And so if an issuer defaults on a bond, you don't receive all the interest and face amount payments, you receive some lower fraction of it. So when a company goes bankrupt and is liquidated or reorganized, bondholders usually lose some money. There's the recovery rate in the event of default is usually, it varies by firm and industry, but it's maybe around 40 to 60 cents on the dollar. So you get some money in the event of a bond default, but you lose a lot. So we want to just illustrate how one simple illustration of computing a default expected bond return. So let's take a quick look at today's spreadsheet. April 9th, default adjusted bond returns. And looking at the top, it's a pretty simple bond. It's a 2-year bond, right? Looks like it has a 5% coupon rate paid annually. So there's really two cash flows. Right? Year 1, we've got the coupon payment. Year 2, we've got the face amount and the final coupon payment. And then in each period, according to this chapter's notation, we've got a probability pi that the bond will not default. Right? So there's a 90% chance that this first coupon payment is going to be made and the firm won't default, just for illustrative purposes. Right? And then in year 2, there's another 90% chance. And so there's 3 possible outcomes with this bond, right? Either we make it through all the coupon and principal payments with no default, and so we receive $50 in year 1, $1,050 in year 2. And the probability of that happening, probability of both of those things happening, both the first coupon payment gets made successfully, that probability is 90%, and then the second cash flow happens successfully, that's also 90%. So the probability of both of those things happening successively, we just take the product of the two probabilities, and there's an 81% chance overall that both of these payments will be made and the bond will not default. And then another thing that could possibly happen in this model is that the issuer makes the first coupon payment. There's a 90% chance of that, but then the bond defaults in year 2. And in this model, we'll assume there's no recovery at all. So if a bond defaults, we get nothing. Okay. So the cash flow pattern, if that happens, in this case, right, we receive the first coupon payment, and then if the bond defaults, we receive nothing. And so the chance of that happening is, well, the probability of receiving the first coupon payment is 90%, right? And then the probability of default in year 2 is 10%, right? So the probability of this second outcome happening is the probability of the first coupon payment happening successfully times 1 minus the probability of not defaulting, right? There's a 10% chance that this year 2 cash flow will be equal to 0 in this model. So there's a 9% chance of a default in after the first coupon payment in year 2, right? And then the third possible outcome is that we don't even get the first coupon payment because there's a 10% chance of a default in the first year. And then if that happens, then there's obviously no payment in the second year. So the probability of that happening, we could just write it down. It's 10%, right? It's whatever the probability is of from defaulting in the first year. Okay. So given the probability, some estimated probability of default in each period for this bond, we can see the probability of each outcome. And then given these probabilities of these 3 outcomes and the cash flows in each of these 3 outcomes, we can compute an expected cash flow, right? So it would be a weighted average of the bond's cash flows where the weights are the probabilities, right? So 81% chance of receiving a cash of the outcome 1, 9% chance of outcome 2 happening, 10% chance of outcome 3 happening. So if we take some product of probabilities and then the cash flows in year 1 across the 3 outcomes, that'll give the expected value of the year 1 cash flow, right? On average, we'd expect to receive $45, given that there's a 10% chance of default, right, in the first year. And then we can do the same thing with the second cash flow. The probabilities of the 3 outcomes times the cash flows in each of the 3 outcomes, add those up, some product, right? And so the expected value of the year 2 cash flow given some probability of default in year 1 and year 2, in which case we'd receive nothing, right? The expected value of the year 2 cash flow is 850.5. So taking into account the probability of default, the way that we would compute a default adjusted expected bond return would be a function of the expected cash flows that we've computed based on the probabilities of default, and then the price we observe. And in this model, the bond has a price of $700. So what we could do is find the discount rate that gives these future expected cash flows a present value that adds up to exactly 700. Right? And so the IRR function does that for us nicely. Right? What is the internal rate of return of this cash flow stream? What's the discount rate that gives these future cash flows a present value of exactly $700, the price of the bond? 13.49. So there's our default adjusted expected return. So in the next video, we'll take the complexity of default probability up a notch and incorporate different default probabilities across different credit ratings. So it's important that you can follow the probabilities outlined in this video before you move on to this probabilities and matrix notation that we'll talk about next. All right, thanks for tuning in as always.